Look at the bottom row of this syllabus outline. Chapter 15, Technical Analysis, commands 15 marks on the NISM Research Analyst exam. Most of the curriculum focuses on fundamental analysis, which builds financial models to estimate a company's intrinsic value. Technical analysis operates on an entirely different premise. Its foundation rests on the efficient market hypothesis. This is the idea that current asset prices instantly reflect all available information. Every earnings report, every macroeconomic data point, and the collective psychological biases of millions of individual decisions are already baked into the current market price. Because the price discounts everything, technicians do not try to forecast the future from external variables. Instead, they study historical price geometry to establish the probability of what will happen next. In real time, market data is chaotic. Millions of orders execute in milliseconds across global exchanges, creating a relentless stream of raw ticks. To make sense of this overwhelming volume, analysts compress the data into a continuous historical record. This chart shows the simplest form of compression, the line chart. Plotting only the closing prices creates a clear visual of the long-term trend. But this simplicity comes at a cost. It erases the violence of intraday volatility. If an asset drops sharply during the day, but recovers by the close, the line chart hides that panic. To truly map the psychological battle between buyers and sellers, analysts need a more granular tool. The Japanese candlestick chart takes that same raw market data and visually encodes it, making market sentiment instantly readable. Each session is represented by a central structure called the real body, capturing the exact difference between opening and closing prices. Thin lines extending from the top and bottom, shadows, or wicks, log the extreme highs and lows tested before the session ended. The color of the body immediately tells the analyst who won the session. A green body means buyers drove the close higher than the open, while a red body shows sellers took control. When you chain these individual sessions together across days, weeks, or months, the chart reveals the shifting dominance between fear and greed over time. In the early 20th century, Charles Dow formalized the idea that these sentiment shifts aren't random. He proposed that markets move in structured, repeating cycles. On this nifty chart, Dow's primary trend is the massive multi-year directional movement driven by macroeconomic forces. Within this upward movement, we see sharp corrections, secondary trends, counter-movements lasting weeks or months, triggered by policy shifts or profit-taking. At the micro level is the tertiary trend. These erratic, short-term fluctuations, lasting days or weeks, appear as random noise when viewed through a monthly lens. These trends cycle through three distinct phases: an accumulation phase, where smart money enters quietly, a public participation phase as momentum builds, and a distribution phase, where early buyers exit. Understanding this fractal architecture prevents an analyst from panicking during a short-term secondary correction and mistaking it for a structural reversal of the primary trend. Because human psychology drives price action, the market develops a collective memory. Buyers and sellers react aggressively when prices return to historical levels. Notice how the price repeatedly halts its decline at this specific level. This is support, a price floor where buying interest becomes so dense it absorbs all the selling pressure. If that buying interest is exhausted, a breakdown occurs. The support floor decisively fails, and the asset's price drops rapidly. However, a true breakdown must be validated by the data at the bottom of the chart: volume. A surge in trading volume proves there is true institutional conviction behind the drop, rather than a false alarm. Once a level breaks, a psychological phenomenon known as role reversal takes place. Trapped buyers look to exit at break-even, turning that old support floor into a new resistance ceiling. Identifying these boundaries and verifying them with volume is how professionals define their risk and place their stop-loss orders. Chart patterns provide a visual map of market psychology, but analysts also quantify this raw price geometry using mathematical formulas called technical indicators. On this Tata Motors chart, the colored lines are exponential moving averages. By heavily weighting recent closing prices, they act as dynamic, curving trend lines that smooth out daily volatility. In the bottom panel, the moving average convergence divergence, MACD, measures momentum shifts between those averages. Just above it, the Relative Strength Index, RSI, acts as a speedometer, scaling recent price velocity from 0 to 100 to flag overextended conditions. These indicators do not predict the future. They are diagnostic instruments used to measure the hidden strength or exhaustion behind an ongoing trend. Technical analysis is a framework for probability assessment. Executing a high-probability trade demands a principle called confirmation. An analyst will rarely act on a single signal. They seek a confluence of evidence from the entire stack of indicators. As seen here, the first layer of confirmation occurs when a decisive price breakout aligns with an institutional volume spike. Extending this vertical analysis down to the momentum indicators, when RSI and MACD move in the exact same direction, the setup is confirmed. An analytical edge is derived strictly from this confluence of evidence, effectively filtering actionable signals from random market noise. What begins as a chaotic stream of raw ticks is translated into a structured, mathematical model of market psychology. The hierarchy of evidence remains constant. Price action dictates the trend, volume validates the price movement, and oscillators confirm the underlying momentum. Fundamental analysis establishes the asset's intrinsic value. Technical analysis observes the actual deployment of capital, identifying high-probability convergence between price and value. By measuring the battle between fear and greed, it allows an analyst to align their capital directly with dominant market forces. This architectural approach satisfies the rigorous requirements of the NISM certification. It converts raw market data into a disciplined, probabilistic strategy for professional execution.